Okay, good morning, ladies and gentlemen. Dzień dobry. Many thanks for having me today. It's a great pleasure to be with you here today at the occasion of your annual fund conference. Just to briefly introduce myself for, I suppose, the many of you that might not know me. So my name is Kian Navid. I'm a Senior Policy Officer at ESMA for Investment Management. And as you know, ESMA is located in Paris, quite far away, but also not that far. So it's a great pleasure to be here with you to engage a bit more. A little bit about me on my background. So I've been with ESMA since 7 years. And during this time, I've been in charge of various policy work streams that you might love or hate. At the same time, I have been in charge of the operational working group of investment management at ESMA. So this is the group that is in charge of the supervisory convergence work of ESMA. And before joining ESMA, I worked, like I suppose many of you, in the private sector, in the investment management sector in different countries, so in Germany, in Canada, UK, and Luxembourg. But that's enough about me. Having this valuable opportunity today to engage with you live and in person in Poland, I'm very thankful for that. And what I would like to do is to present to you some priority issues from an ESMA perspective. And I will firstly focus on the macroprudential situation for investors and investment managers in light of the recent stressed market conditions. And then I will move to the second focus area of sustainable finance, which is of high strategic importance for ESMA. And then I will finish my speech with the third focus area of costs and fees of investment funds, which is another very important topic to ESMA. So the first topic that I would like to cover today concerns investors and market participants equally, namely the current macroeconomic environment and its implications for macroprudential supervision. In recent years, we've gone through several unexpected crises of different nature, creating unprecedented challenges for investment managers and the EU economy at large. Following the COVID-19 pandemic, the Russian invasion of Ukraine, whose western borders are not far from where we are meeting today, dramatically affected the risk environment of EU and global financial markets. Investors and market participants have become increasingly concerned about a global economic slowdown. And in some jurisdictions, there is even a fear of recession, or it has even materialized. Volatility has increased, and market corrections have materialized in certain market segments. And inflation has risen sharply, as you know. It's the highest level since the early 1980s that we have witnessed in terms of inflation. And the Russian invasion of Ukraine further increased pressure on prices from resulting supply shocks for markets in energy, in food, and other commodities. And higher energy prices, as you know, we have reached 10-year highs, have particularly contributed to inflation in the Eurozone and the EU at large, widely increasing, therefore, production costs and distribution costs. And as a direct consequence of that, well, you have seen that central banks have tightened their monetary policies to reduce demand and bring back down inflation. And interest rates have risen pretty sharply. I think many of us didn't expect that central banks would react this swiftly. And I remember talking to various risk managers and fund managers about stress testing scenarios. And many didn't expect that central banks would react this swiftly, raising interest rates the way they have to fight inflation. And these recent developments create a new economic environment for financial markets in general, but also the investment management sector in particular. So investment managers need to adapt to this new reality after operating for many years in a low yield and low, inflation environment. Now you have a new reality to deal with, a new challenge to deal with. And you might have seen that last year, the assets under management of investment funds experienced their sharpest decline in the EU since the global financial crisis. So since the 2007-2008 financial crisis, this has been the sharpest decline, altogether minus 11%, bringing the assets under management at the EU level down to 16 trillion euros. Equity funds declined by 16%, and bond funds declined even by 17% and witnessed some significant outflows due to performance-driven factors. But the positive observation is that despite this stress, investment managers in the EU have dealt quite efficiently with redemption requests, thanks to rigid liquidity management and the use of liquidity management tools. And I will touch upon the regulatory framework and how the remaining vulnerabilities in the investment management sector are being monitored and addressed by ESMA in a few minutes. But I can already say that the cooperation between ESMA and the national authorities, such as the KNF, has been fruitful and efficient during these times of crisis, which has been very important, with increased exchanges of supervisory information and intensified monitoring of liquidity and valuation issues. You might have seen that the economic sentiment has become a little bit more positive since the beginning of this year. And of course, this is a relief. You saw even some indices regaining some of the losses or even reaching new all-time highs. But certainly there is no room for complacency because of the existing vulnerabilities. And therefore, it's crucial to identify and monitor and address the remaining vulnerabilities in the investment management sector and the possible channels of contagion to the other sectors of the financial system. And this leads us to the importance of making sure that we have the right regulatory framework for this, and this is the task that ESMA has, as you might know. And here, in 2021, so 2 years ago, and after a decade since the implementation of the AFMD, the European Commission published its legislative proposals for a review of the AFMD, also with some implications for the UCITS directive. And these proposals aim at addressing the vulnerabilities identified by European supervisory bodies as well as global supervisory bodies. And these include, amongst others, developments on the availability, design, and use, as well as disclosure of so-called liquidity management tools. You will be familiar with them. In some member states, they have been used more frequently over the past decades, and others less. But their availability and clarity on how to use them and how to disclose them to investors is quite key, especially during these stressed market conditions. Another important element of the AFMD review is the harmonization on the rules of loan origination funds. And a third element worth stressing is the creation of a reporting regime for UCITS. So ESMA has provided a number of policy recommendations already a year prior to that, so in 2020, and we're quite happy to see that many of the recommendations that we have made to the European Commission have been taken on board. So as you can imagine, we're quite supportive of what the Commission has been putting forward. And we are also very supportive of what the other co-legislators, so the European Parliament and the Council, have put forward, especially on the liquidity management tools side, because this is a key issue that we see to make sure that fund managers across the EU have a right liquidity management tool set at their disposal. And you know, there's a variety of tools: swing pricing, liquidity buffers, redemption periods or notice periods, and various other tools. And there is ongoing international work also at IOSCO level. So we're happy to see that the European Commission has taken forward our recommendations to put this into legislation to provide some further clarity to you and to the industry across the EU to make sure that we're well prepared for future episodes of crisis. And as you might know, the European co-legislators and the European Commission are still negotiating on these proposals. I think just a few days ago they were meeting until 1 o'clock in the morning, so quite intensive negotiations. But we're hoping that there will be soon a political agreement on the various important aspects of this review. So, I've spoken a lot now about the regulatory framework, but let me also spend a few minutes to talk about what we're doing at ESMA in terms of supervisory convergence and risk monitoring. At ESMA level, the liquidity of investment funds is a risk that we have been actively monitoring together with our colleagues from the national authorities, especially since the COVID outbreak. And amongst other initiatives, we carried out work together with our national supervisory colleagues on a number of initiatives, in particular the so-called ESMA Common Supervisory Actions Exercise, the CSA, you might have heard of that, or you might have been impacted by that, on various issues, in particular on UCITS liquidity risk management. And we also did some work on the implementation of the 10 ESRB recommendations on liquidity risk in corporate debt and real estate funds. As you know, these are sectors that are more impacted by the current macroeconomic situation. So quite a lot of supervisory work together with our national supervisors. And some of the main shortcomings that we identified through these supervisory exercises were pretty much consistent with those highlighted by other international authorities. For example, these exercises showed that there is a need to increase the availability and the usability of liquidity management tools by investment funds, and also sharing information between national and European authorities on liquidity management. And I mentioned earlier that this is something that we're hoping that the EU legislators are going to address very soon with the review of the AFMD and UCITS directive. And at the same time, of course, it remains important that fund managers comply with their legal obligations, so ensuring that their investment strategy is aligned with their liquidity profile and their redemption policy of the various funds that they manage. And it's also essential that their governance structures and their internal control frameworks remain strong. This is a weakness that we identified in some cases across the industry. I know that supervisors are actively engaging with the relevant companies, but I would like to emphasize that given the current market conditions that we're in, this remains of high relevance to the industry. And finally, one additional aspect to highlight is liquidity stress testing. I don't know how many of you are risk managers, but liquidity stress tests are naturally a very important element. And as you might know, ESMA issued guidelines on this very important topic already in 2019, so before the COVID crisis. It was a good timing. And we expect that the lessons learned from these liquidity stress tests come in quite handy now, given the new macroeconomic situation that warrants greater vigilance both by you in the industry and us in the public sector. So, in conclusion, when it comes to the first priority topic of macroprudential risk, we at ESMA believe that the regulatory reforms are going into the right direction. So we're quite happy about that. Although, of course, we need to remain vigilant, both us in the public sector, but more importantly, even you in the private sector, to make sure that we're prepared for potential future crises. So, moving on to the second priority area, namely sustainable finance. It has been brought to our attention that currently there are only a limited number of ESG products in some member states, including Poland, compared to other member states where there's a variety of ESG products. And this has been explained to us by a lack of reliable data to develop such products and the fear of greenwashing. And it goes without saying that we at ESMA naturally hope that this important market segment can continue growing over the next years, not only in Poland, but across the entire EU. And yes, there are valid investor protection concerns and data challenges that we hope that we can overcome together. And I will speak in a few minutes about what we at ESMA are doing to help with the situation. But before doing that, it's also important to acknowledge that the investment management industry has an important role to play to contribute to climate transition. And we at ESMA are aware of the practical challenges that you're facing in implementing these new rules, but also for national supervisors in supervising these new rules, especially as the different pieces of this new regulatory framework on sustainability are not all finalized yet and will only gradually fall into place over the next year. So this is something that over the next years will gradually fall into place, and therefore the road to sustainability is challenging and quite complex, not only to you, but also for us in the public sector. So let me speak about what we at ESMA are doing to contribute to the sustainable finance agenda. So in terms of policy work, the sustainable finance disclosure rules in the so-called SFDR, you might have heard of it. I don't know if you use the same acronym in Poland, but it's the SFDR. I see people nodding. So this kept us quite busy at the European level. So we at ESMA, together with our sister authorities, EIOPA and EBA, so on the insurance and banking side, we worked on this over the past years, and in 2021, we developed the implementing rules, the so-called technical standards, which eventually started applying at the beginning of this year. And after having been adopted by the European Commission, they're now fully in place and applicable. But the technical rulemaking is not over yet, as we have received actually a new mandate from the European Commission in April this year to review certain elements of this regulation, in particular the so-called principal adverse impact indicators, you might have heard of them, and also looking into the financial product disclosures of the SFDR framework. And this request from the European Commission covers extending the list of the universal indicators for principal adverse impacts and refining their content and revising the financial product disclosures to include transparency about decarbonization targets, which, as you know, is a priority issue for the European Union. So in terms of the next steps, you might have seen that we have launched a consultation paper in April to gather views from stakeholders, and we're aiming to finalize the technical standards by the end of October. And as you know, sustainable finance is a rapidly evolving framework, and it's fair to acknowledge that there are several challenges. So it's far from perfect. The ambitious timing is one issue, naturally given the urgency of the climate transition. Secondly, the access to data and reliable data is a second very big challenge. And then thirdly, the complexity of the issue, both for market participants, so for you to develop and manage such products, but also for retail investors to understanding them. I recently had a private experience with that, as my sister wanted to buy a fund for her little son, so my nephew, and she preferred to have an ESG product so that she can also contribute to the climate transition. And it's quite complex to understand, for her it was very complex to understand what is the right product to buy. And she asked me, and to be frank with you, even for me, it was not straightforward looking at some of the disclosures, and this was before the SFDR became fully applicable. So here certainly there is room for improvement, since investors going forward will more and more look into these types of products to help the carbon transition. So in terms of the upcoming EU regulations that are intending to help with this, so one thing worth mentioning is the so-called Corporate Sustainability Reporting Directive, the CSRD, which aims at improving problems that affect the data availability and the data reliability, and will hopefully help to provide investors with more reliable information on corporates to understand their ESG characteristics. And in addition, the European Commission is considering legislative proposals to regulate ESG rating providers. And the outcome of this initiative is expected to result in more harmonized and comparable ESG ratings and information on corporates. So that's also very important. But in the meantime, the SFDR framework that we have is already applicable, and the level 1 rules are applicable since several years. So we also need to make sure that we comply with the rules that are in place already, the existing rules. And this is the second aspect I would like to cover, namely the risk of greenwashing. Of course, as you know, with growing market trends, there are also growing risks, and the growing risk of greenwashing is at the core of the debate, since the Sustainable Finance Initiative can only succeed if the confidence of investors in these products is not hampered by products that promise to be very green or very social, or to follow a very specific approach to implementing their sustainability objectives, but then don't really fully deliver on their promises. So investor confidence is key if we want to make this policy initiative a success. And to avoid greenwashing, on the policy side, you may have seen that we have worked together with our sister authorities, EBA and EIOPA, providing various pieces of work on the regulatory side and guidance. So we have provided technical standards, technical advice to the Commission, supervisory briefings to national supervisory authorities, and many, many Q&As. And of course, having rules and guidance is important, but the actual compliance even more so. And naturally, the industry is first in line to ensure compliance, so putting in place stringent checks and controls. But at the same time, rigid supervision by national supervisors is a key priority to achieve our policy goals. And given the EU-wide relevance of this topic, we also strive for convergent supervision across the EU. In fact, many of you might know that since the review of the ESMA regulation, this is the regulation that we at ESMA are subject to, it happened a few years ago where they updated the regulation. And under this updated regulation, we now have a legal obligation to define so-called union-wide strategic supervisory priorities. So these are priorities that we agree on together with our colleagues at the national level. And then we coordinate together with them the work to be done at the supervisory level. And in this context, ESMA announced end of last year that sustainability will be the union-wide strategic supervisory priority. And as part of this exercise, we announced last year that we will perform a common supervisory action together with our national competent authorities. And since last year, we worked together with them at or on the assessment framework for this exercise. And as you can imagine, coordinating on a supervisory exercise across 27 EU member states and 3 EEA member states, so Liechtenstein, Norway, and Iceland, is quite a challenging task. So you have 30 different member states, 30 different market specificities and preferences. It's not a very easy task, as you can imagine, but we're happy to report that we agreed together with our colleagues at the national supervisory level on the key aspects and characteristics of this supervisory exercise. So the scope, the timeline, the questions to be investigated, the expectations, and the coverage. And in a nutshell, starting with the timeline, it's as follows. So those entities that are in scope, so some of you probably, will be contacted by their national authorities in the coming days or weeks. And the exercise will run until the end of September next year, so a little bit more than a year. And then national authorities will report back on the outcome of their national supervisory activities to ESMA, and we will consolidate their reports and provide an ESMA final report probably around end of next year, more realistically early 2025. And in terms of scope, this exercise will cover alternative investment managers, but also UCITS management companies and their funds. So we will be looking both at entity-level disclosures and product-level disclosures. But not only disclosures, we will also look at the integration of sustainability risks in the organization of the entities. This is quite important to us because, having clear disclosures in place, of course, is important, but the actual implementation in the operational processes in risk management and portfolio management and other operational processes arguably is even more important. So this is why the CSA will cover both of these aspects. And we hope that this will provide us and also the European Commission with valuable insights on how the sustainable finance rules are put in place and whether there is a need for any improvements. So, in conclusion, there is much work going on sustainable finance. It's a quickly evolving framework. Both on the policy-making side, there are some initiatives that are aiming to improve the situation, in particular on the data availability and reliability. We, at the ESA's level, we're continuing to provide guidance to the extent possible to the to the industry. We have issued many Q&As, and I think it's fair to assume that we will continue doing so. And also on the supervisory side, as I mentioned to you, we will launch an exercise to understand a bit better how you are implementing these rules and how they're applied and whether there are any challenges to overcome over the next years. So the combination of these different measures will hopefully help to overcome the various challenges in this area, which is of course of high importance to ESMA and the EU as a whole. So, I mentioned 3 priority areas. The final priority area that I would like to cover today relates to costs and fees of investment funds. And as you might know, the European Securities and Market Authority publishes annual studies on costs and fees, as well as the performance of investment funds throughout the European Union, which focuses on the impact that costs are having on the returns for investors, in particular retail investors. And the studies over the past years show that in particular retail investors, they lose out due to high costs associated with investment funds. And on average, retail investors pay 40% more than professional investors or institutional investors. And that is, of course, concerning for us at ESMA level. And despite the data issues that we have observed in this area, there are several studies that all point to the same conclusion, including from the European Commission, namely that costs are relatively high, in some member states more than in others, but also when comparing internationally to some other markets, such as the US, the costs of investment funds are still relatively high. Now, there's quite a divergence. There are some member states, like the Netherlands, that on average have the lowest fees in Europe, together with the United Kingdom, whereas other EU member states, such as Poland, find themselves at the higher end of the cost spectrum. And these investment constraints, I would say, for retail investors are of course concerning to ESMA. These studies have been also confirmed by the European Commission, most recently in their retail distribution studies, which basically came to the same conclusion. And for many European investors, as you can imagine, a sizable part of their potential returns will be eaten up by these increased costs, which naturally poses an obstacle for them or disincentive to entering the capital markets and therefore investing money more productively. So if we want to enhance retail participation, we need to look at costs because this is a key element for retail investors. So especially, by the way, in the current market situation, which is characterized by, well, heightened inflation and the tightening of the financial conditions. So especially in these market conditions, you need to be very attentive to costs. And as you will probably know, the UCITS directive and the AFMD are already explicitly forbidding fund managers from charging undue costs. And to investigate this issue, we launched a common supervisory exercise together with our colleagues at the national level to investigate these rules. And the outcome was that there is some level of subjectivity on the notion of undue costs. So what is undue? What is due? And our national colleagues reported to us that market participants are having different views, divergent approaches to this issue. And there is a need for more legal clarity on what is due and what is undue cost. And our national colleagues also reported that they would wish to have a stronger legal basis for taking supervisory actions or enforcement actions. So making sure that undue costs are not charged, and where they are charged, that investors are compensated. So these are, of course, important calls that we took into consideration. And against this background, we issued an ESMA opinion on undue cost that was issued last month. The opinion was addressed to the European Commission and the co-legislators. And in this opinion, we asked for further harmonization of the notion of undue costs. So what is undue? What is due? What can fund managers charge and what is not eligible to be charged? And in this opinion, we specify that it's not only important to look at the eligibility of the cost category, so what are the categories of costs that you may be able to charge, but also the quantum, so how much you can charge. Because here also we saw some shortcomings and some potential risks in terms of how much you can charge on an eligible category. Because we at ESMA naturally believe that costs that you charge should always be in line with fair market standards. So we saw merit in being a little bit more specific in the legislation on the quantum as well. And you might have seen that in the meantime, it's relatively recent, the European Commission has already put forward some legislative proposals on this and taken on board many of our ESMA recommendations, so naturally we're quite happy to see that. And we hope that these new legislative proposals, which need to be, of course, negotiated together with the European Parliament and the Council, will put in place a regulatory framework that protects investors a bit better from being charged with undue costs and provides national authorities with a stronger legal basis to take supervisory and enforcement actions. And in those cases where, despite all the regulatory protections, costs were charged that were undue or too high, that national authorities have a clear legal hook to ask for investor compensation, which is very important to us. And yes, when speaking of costs, naturally the ESMA work on performance fees also needs to be mentioned. I was made aware that this is a topic of particular interest to Poland, because the Polish fund industry has a widespread use of performance fee models. And as you will know, the ESMA guidelines on performance fees were published in 2020, so just 3 years ago. And the positive observation so far is that the level of compliance that has been reported to us is relatively high. So almost all national authorities confirmed their full compliance with the guidelines, and they've taken all the necessary actions to implement the guidelines into the national framework. And following the entry into force of these guidelines, we received some questions from the industry on the practical implementation. So how do I apply these rules on a day-to-day basis? There were some specific issues that were raised to us, for example, on the crystallization period, on the performance reference period. What happens if I create a new sub-fund or a new share class? How do I apply these rules? And to address these questions, we have issued quite a number of Q&As, I think 7 Q&As on the UCITS side, and 9 Q&As on the AFMD side, so altogether 16 Q&As. And in this context, we also discussed very intensively with our national supervisors the level of compliance by market participants observed by them was relatively high, so they reported that there's a good level of compliance. And they also reported that they haven't observed any increase in terms of the fees charged to investors. So there are no higher fixed fees that managers are opting to as an alternative to performance fee models. So this is, of course, positive to us. Now, the guidelines are only in place since 3 years, but I think at this stage, it's good to see that the level of compliance that is observed by national supervisors is high. But of course, if you in the Polish fund industry see any issues with this performance fee guidelines or the issue as a whole, we're very happy to engage. You might know that more recently we actually implemented a Q&A web tool. Maybe I should use this opportunity to also promote that. It's a web tool that we published on our website where you can very easily and quickly submit questions to ESMA. Now you can imagine we receive quite many queries from all the different European countries, but it helps us to understand what are the issues in terms of practical application of the rules. And then we take all these queries that we receive and discuss with our colleagues from the national supervisory authorities on a regular basis on the issues that merit further guidance. So where we see that there's a pattern of uncertainty or a need for more guidance. And then we consider issuing either ESMA Q&As or Commission Q&As. So if you are having any doubts or questions on any of these pieces of ESMA guidance, for example, on performance fees or others, please feel free to use this web tool, because I think that's very helpful to us to engage with you through that tool. And yeah, so that is basically it. To conclude my speech today. So I spoke to you about 3 priority areas. The first one is macroprudential supervision. The second one was sustainable finance, and the third one, costs and fees. And on all these 3 areas, yeah, we have come a long way together with our colleagues from the national supervisory authorities over the past years. But clearly the journey is not over. There's still various challenges ahead of us given this new macroeconomic situation that we're all facing, which is quite challenging. And I will stop here by thanking you for the invitation and your engage both you at the national level, but with us also at the European level on the challenges faced. So I'm very happy to take any questions that you might have, either now if we have time, or of course later during the coffee breaks.